Hello, fellow intelligent investors. My name is René and today I want to continue to talk about Howard Marks' latest memo. In this video, I discuss to what extent the emergence of new and technology-based business models that can be scaled much more rapidly and frictionlessly presents a challenge for investors when it comes to their attempt to value businesses properly. So if you want to learn whether you need to adjust your investment framework or process, stay tuned.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, this is actually the second video of a three-part video series in which I discussed some of the most important points Howard Marks brought up in his latest memo. So if you have missed my first video on this topic, in which I share my first key learning from Marks, make sure to check out this video first. And as always, it would be much appreciated if you like the video, leave a comment, or even subscribe to the channel. So, besides the false dichotomy between growth and value, which I discussed in the last video, Marks discussed another concept that I want to share with you today. A second point Marks makes is how the internet, or more generally speaking technology, changed the investment landscape. If you have followed the markets in 2020, you will have noticed that especially internet-based businesses have been major beneficiaries of the coronavirus pandemic. The pandemic and the subsequent lockdowns have changed people overnight, I would say. And these behavioral or habitual changes will likely persist and have a big and lasting impact on businesses. For instance, more and more consumers are ordering online nowadays. In fact, market research reports indicate that the coronavirus pandemic has pulled forward e-commerce penetration by about 3 to 4 years. And there's actually a term for this development. According to Wikipedia, a new normal is a state to which an economy, society, etc. settles following a crisis, when this differs from the situation that prevailed prior to the start of the crisis. And I think it is fair to say that what we are seeing is likely a permanent acceleration of the shift to online. There will be no going back, if you ask me. Just think of e-commerce companies like, for example, Etsy or C Limited, whose stocks have gone up 5x or almost 10x since the March lows. And these companies have also seen insane year-over-year growth rates. And similarly, gaming companies, be it gaming publishers or developers, or employment marketplaces like Upwork or Fiverr, have also hugely benefited from the pandemic. Now, what does all of this have to do with Howard Marks' latest memo, you may wonder? Well, in his new memo, Marks essentially outlines that a key strength of investors is to always be open-minded and to be willing to adapt to a new environment. And he himself describes himself as a very cautious investor who's always focusing on the downside risk first before considering any upside potential. A bargain hunter that isn't willing to pay higher multiples for a stock. He writes, "These influences and experiences led me to adopt a value approach and the person of a bargain hunter, which has served me well in my chosen field." But over the course of his essay, Howard Marks then keeps contrasting his philosophy to that of his son Andrew, who is also working in the investment industry. He writes, Andrew's first phase was spent as a Buffett nerd, consuming everything written by the Oracle and adhering strongly to his philosophy. But over time, he has developed his own perspective and transitioned to investing primarily in technology and other growth-oriented company. This contrast of viewpoints, particularly in 2020, has created extraordinary opportunities for discussion and learning. When I consider this new world, I think fundamental investors need to be willing to thoroughly examine situations, including those with heavy dependency on intangible assets and growth into the distant future, with the goal of achieving real insight. Basically, Marks admits that he too needs to adapt his investment approach to the new world we live in right now. Obviously, the internet is not new, but the impact of technology has certainly become much stronger in the recent years. And this trend was reinforced in a way by the pandemic and people being stuck at home. Now, with regard to this change, Howard Marks raises awareness for a couple of trends that investors need to be aware of. Firstly, innovation and technical adoption are happening at a much more rapid pace than ever before. And secondly, since many of these companies are selling products primarily made with code, their cost of capital requirements are extremely low, and their profitability, especially on incremental sales, is unusually high. Thus, the economics of winners have never been more attractive, with very high profit margins and minimal capital requirements. So the point Howard Marks is making here is that internet-based businesses that don't require a lot of tangible assets, can scale their businesses much more rapidly and frictionlessly. By contrast, physical items are much heavier and they take up space and they need to be stored somewhere, and storing requires money, of course, and so does transportation. And so margins of such companies will obviously be smaller. And overall, it just takes longer to produce and scale a business that relies on physical assets. And again, Marks stresses what I have just said here. Because the friction and marginal cost of scaling over the internet can be so low, businesses can grow much more rapidly than ever before. So unlike traditional businesses that rely primarily on physical assets and where growth is bounded by the physical limitations of a product's weight, maybe the opening hours of a store, the construction time of a new factory, logistics and transportation, there are much fewer constraints in the internet. And growth rates of such technology and internet-based businesses are often not limited by physical constraints, but rather by people's behavior, because people's behavior often changes much more slowly. But as I've just pointed out, I think the coronavirus pandemic has basically pulled forward this behavioral change. I think what Marks describes in his memo, so the fact that some companies can grow much more rapidly than in the past, has one major implication, and that is that valuation work becomes much harder and is much more challenging. And I think there are three reasons for the fact that valuation becomes more challenging. Firstly, the range of possible outcomes is much greater and therefore harder to predict. It's important to consider the probabilities of different outcomes, as there will often be massive winners but also many massive losers. Just consider marketplace network effect businesses, or maybe network effect businesses in general, because networks tend to see a winner-takes-all effect. This helps businesses get very big very fast, but of course there will also be many losers. Marks describes a disruptive company in his memo, a company that has seen considerable growth but is still not really profitable yet. Company B seems more conceptual in nature and more dependent on developments in the distant future that are subject to significant uncertainty. So valuing it might have to be done on the basis of broad ranges for future sales and profitability, rather than reliable point estimates. Now, I think there are two more reasons why valuing businesses has become more difficult. A key input in a DCF, so a discounted cash flow method, that helps you estimate the intrinsic value of a company. Well, a key input is a firm's cash flow, like the initial cash flow. How much cash does the company generate today? And this is one of the most important inputs in your DCF model. But today, many businesses focus on scaling their business first. They want to be the winner that benefits from the winner-takes-all effect. And therefore, they plow all of their cash flows back into the business, which makes it harder to come up with a correct cash flow input in your DCF model. You can only guess what kind of margins the company will have in the future, or could potentially have right now if it would not reinvest all of its profits. And again, here's what Howard Marks wrote about this development. It has never been more acceptable for public companies to lose money in the pursuit of a large prize down the road. This in turn leads to obfuscation of the real potential economics of winners and makes differentiating between winners and losers difficult without great, insightful effort to peel back the onion. So in a way, he stresses the point that I've made in my last video. Investors cannot only rely on their quantitative analysis and instead their judgment regarding qualitative factors will be a key component of their potential returns. How long can the company continue to grow at a high rate? What's the total addressable market? And how will the total addressable market develop over time? How durable is the moat, and for how long of a period can the company continue to earn high rates of return? Marx wrote, "The key to success lies not in the ability to perform a mathematical calculation, but rather in making superior judgments regarding the relevant inputs." And quite frankly, I have to admit that this is something I have massively struggled with as well. In fact, one of the overarching investment principles that is part of my investment framework, my investment checklist, is that the company needs to be cash flow positive. But then there are superstar investors like Pat Dorsey, who I look up to, but who bet big on companies like Wix.com, a company which develops and markets a cloud-based platform that basically enables anyone to create a website. And I've used the Wix product, so the product of the company, and I think it's awesome. I really love it. But I still struggle with valuing the company properly because the firm is trading at such a high price to free cash flow ratio and still throwing off relatively little cash as it keeps reinvesting into the business. So in a way, I feel the same way like Howard Marks feels, because he writes, "When I consider this new world, I think fundamental investors need to be willing to thoroughly examine situations, including those with heavy dependency on intangible assets and growth into the distant future, with the goal of achieving real insight. However, this is, to an extent, anti-ethical to the value investor's mentality. Part of what makes up a value investor's mindset is insistence on observable value in the here and now, and an aversion to things that seem ephemeral or uncertain." And then there is a third reason why valuation is possibly more challenging now than ever before. Due to the developments that I have just outlined in this video so far, it seems likely that some companies can grow at high rates much more longer, which makes valuing them again much more difficult. And that's because a DCF usually consists of 2 to 3 stages. There are 1 or 2 or maybe even 3 growth stages. And then there is a phase of terminal growth, usually after year 10. And as no company can grow faster than the company forever, because then it would become the economy, growth will eventually slow down. That's true for every business. In fact, growth often drops off significantly as companies continue to grow. Just take a look at this McKinsey chart. The chart visualizes the long-term behavior of revenue growth across publicly traded US companies and shows that no matter how high or low a company's growth rate, over time growth has historically converged to about 4 to 5% on average. And that's why investors usually use a very conservative estimate in their DCF. Most investors I know simply go for a terminal growth rate of 2 to 3%. And if you consider inflation, this practically means that the company isn't growing at all. A DCF considers all future cash flows and discounts them back to the present value. And what's important to acknowledge here is that the terminal growth period is often the largest component in the total present value. If you go for too big of a terminal growth rate, you will quickly misjudge the intrinsic value of a company. You will overpay for the stock and, as a consequence, harm your investment returns. However, there might be very, very few businesses that can continue to grow at a higher rate after year 10. But it's very hard to predict which businesses will achieve such exceptional results. Now, as we have just pointed out, businesses that primarily rely on intangible assets and due to the internet can scale their businesses very rapidly. Here you might underestimate the intrinsic value of these businesses if you go for too low of a terminal growth rate, maybe even for too low growth rates in the initial growth phases of the DCF. And Howard Marks addresses this problem as well. Let me share a few truly enlightening quotes taken from his memo. And as I try to keep my videos a little shorter, I will not read these last quotes to you, but instead you should simply maybe pause the video. And I can only encourage you to read these quotes twice. Overall, I think those are some incredibly powerful quotes. And Marx raises some interesting questions that investors need to think about if they want to successfully invest in the 21st century. And this brings us to the end of the video. As always, may your finances and investments prosper. Good luck.